Hi, I'm Gabe Stepler. I'm an accounting professor here at Limestone College, and I thought we'd take a little time to introduce the Management Accounting BA610 MBA program course, a little overview, and perhaps a little review of what you're going to be working with. First thing, just as a review, the differences between management accounting and financial accounting. These differences are blurring today, but we still have some finite differences. Basically, in management accounting, we're working with internal decision makers. Financial accounting is primarily concerned with people outside or external to the company and their decisions. Management accounting is more future-oriented, whereas financial accounting is a history, it's past data. Management accounting also uses small data, whereas financial accounting is more concerned with aggregate numbers, large numbers. And finally, the management accounting reports are formatted for internal users as described by those users, whereas financial accounting is dictated by generally accepted accounting procedures. In the recent past, there was a distinction between the work of management accountants and financial accountants. And the only commonality really was in cost accounting. If we had financial accounting, management accounting, common ground in the past was cost accounting. And really, management accounting has grown out of the old field of cost accounting. The reason these came together because in cost accounting, the output from cost accounting determines some of our financial data. For example, on our income statement, we have cost of goods sold. Well, people in cost accounting prepare that data, and there are certain rules for our income statement, both from the IRS and from generally accepted accounting principles. So on the income statement, we have cost of goods sold, which comes from this data prepared by cost accountants, and also on the balance sheet, we have inventories. Now, the early focus of the course and the changes that have transpired over the last 30 years, you can see here in the Institute of Management Accountants, which is the professional association for management accountants, their trade publication was called Management Accounting. How fitting. Today, it's called Strategic Finance. So we see we have a coming together in many ways so that today, people working for a corporation are basically management accountants, and those doing audits and public accounting are financial accountants. But it's blurring very much. Emphasis in the text that we'll be using is on manufacturing, but most of the cost techniques explored can and are applied to distribution and service industries, and to not-for-profits and government entities. Cost accounting, we'll be dealing with cost identification and classification of costs. We have direct and indirect costs. The direct costs are easily identified, easy to calculate, whereas the indirect are more complex and generally will get split off and spun off into something called overhead, which is then allocated to products. Now, the overhead component of the three cost components for manufacturing, direct materials, direct labor, and overhead, the overhead has shown the greatest growth as far as percentage of total product cost. Direct materials in the past were probably about 30% of the total cost. Direct labor was about 50%, and manufacturing overhead was about 20%. Well, over the years now, as we become more technologically advanced in manufacturing and more machine intensive rather than labor intensive, today direct materials is holding at about 30%, but direct labor is down to about 10%, and overhead is about 60%. And today now, errors in the allocation of overhead to products can cause material errors in product cost estimation. If we overestimate the cost of a product, what's going to happen? We're going to overprice the product. All right? We'll probably not be competitive and lose sales. If we underestimate overhead, the product is probably underpriced and we will lose profits, or we will actually experience a loss if the actual price, actual cost of the product is greater than what we're selling it at. So traditional manufacturing overhead allocation was volume-based and on products consumption of either direct labor or machine hours. A major development was to change the focus from volume to activities. Activities drive costs, not relational to volume of units produced. So this led to activities-based costing and then activities-based management. Your course will include working with SAP software for ABC costing. Mapping activities instead of volume led to many of the innovative management techniques employed over the last 20 years. We now have such management techniques as balanced scorecard and strategy map. It's involved with financial performance, customer satisfaction, internal processes, learning, and growth. We also have value chain concepts now, where we look at all these activities that we've mapped out and have a better understanding of which ones are providing value or value-added activity and those that are non-value-added activities. So we try to minimize those that are non-value-added and maximize the value-added activities. We have business intelligence techniques today, employing statistical methods, regression analysis, and correlation to see critical success factors. This is similar to the balanced scorecard, but it's probably more analytical. We have target costing. The old way, when we were very much product-oriented instead of customer-oriented, was to start with an idea, develop the product, whatever the cost, and then try to sell it at a price that customers would accept. But today we start with market research to determine a competitive price, then determine the required gross profit requirement, and design, production, and product to come in under a target cost. Another concept that's very current in accounting today is the life cycle costing, where we go through the typical life cycle of a product from introduction to growth to maturity to decline. We have to take our costs and allocate them over all these periods of growth. We can't just look at what the maximum will be or the minimum. We have to take a long view, a strategic look on products and where the costs for these other activities. For example, in financial accounting, all of these activities, R&D, design, promotion, distribution, service, are recorded as expenses in the period in which they are incurred. We have to project them in management accounting over the entire life cycle. We have others, benchmarking and total quality management, lean accounting, that are explored in this course. And then we also have theory of constraints, which is all about reducing cycle time by eliminating unplanned constraints. Starts with product design, development, environmental resource planning. Interesting, like a company like BMW, only about 30% of its output is shipped to dealers. The other 70% is custom. Okay, the other thing we need to really mention here is that there are two competitive strategies, strategic strategies, that are employed in the text. One is cost leadership, the other is differentiation.